and welcome to the channel. Ever wondered what makes a stock incredibly expensive to borrow, hinting at a potential short squeeze scenario? Today, we're diving deep into a fascinating microcap medical device company, ICCM, or ICCM Medical Limited, which has recently popped up on our hard-to-borrow screener with some eye-watering statistics. We'll break down what makes ICCM unique, why its cost to borrow is soaring, and what that could mean for its future price action. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's start with ICCM Medical Limited. ICCM operates in the healthcare and medical devices sector. This is a commercial stage medical device company focused on the research, development, and marketing of advanced cryoablation systems. Their flagship product, the ProSense system, is designed for treating various tumors, and the company has a global footprint, operating in the United States, Japan, India, China, Israel, and other international markets. With a current market capitalization of just $12.06 million, ICCM is a true microcap, often characterized by higher volatility. What is cost to borrow and why it matters? Before we get into ICCM specifics, let's quickly explain cost to borrow, or CTB. When you short a stock, you're borrowing shares from a broker to sell them, hoping to buy them back later at a lower price for profit. For the privilege of borrowing those shares, you pay a fee, known as the cost to borrow. This fee is typically expressed as an annualized percentage. A high CTB indicates strong demand from short sellers, a limited supply of shares available to borrow, or both. When CTB fees exceed 100% annually, it signals a highly contested stock, as short sellers are paying a significant premium just to maintain their positions. Why this stock is hard to borrow right now. Now, let's look at why ICCM appeared on our screener. Its annualized cost to borrow fee currently stands at a staggering 627.5%. To chart, CTB spike that's not a typo, over 600% annualized. What's more, this isn't a stagnant figure. ICCM's CTB has seen significant momentum, increasing by a remarkable 71 percentage points over just the last 5 trading days. The supply of shares available to borrow is also incredibly tight, with only 100,000 shares currently available. When you consider ICCM's estimated float is 1.2 million shares, having only 100,000 available to borrow represents a very small fraction of the tradable shares. Our internal composite squeeze score, which evaluates various factors like CTB, borrower supply, and technical setup, currently gives ICCM a score of 51.3 out of 100. To price chart, interestingly, despite this extremely high CTB, ICCM's recent price action has been somewhat subdued. Today, the stock is up plus 1.81%, and over the last 5 days, seen a modest increase of plus 0.41%. However, looking at the last 30 days, ICCM is down minus 19.63%. This suggests that while short interest is high and expensive, short sellers might have strong conviction in the bearish thesis, while the stock simply hasn't found sustained buying momentum yet. Squeeze mechanics explained. So, what is a short squeeze? It's a phenomenon where a stock's price suddenly surges, forcing short sellers who bet against the stock to buy back shares to limit their losses. This buying action, in turn, drives the price even higher, creating a positive feedback loop. For a stock like ICCM, with a limited float of 1.2 million shares and only 100,000 available to borrow, the mechanics are particularly sensitive. If positive news or significant buying pressure were to emerge, short sellers paying that 627.5% CTB would be under immense pressure. With so few shares available, even modest demand to cover short positions could create a rapid rush to buy, quickly depleting the already scarce supply and potentially sending the price parabolic. Dilution risk check. An important factor to consider for any potential short squeeze is dilution risk. Dilution occurs when a company issues new shares, which increases the total number of shares outstanding and can reduce the value of existing shares. Even with a high cost to borrow, significant dilution can negate a squeeze thesis by providing a fresh supply of shares for short sellers to cover, or simply by depressing the stock price. For ICCM, our checks revealed no recent dilutive SEC filings such as SMINUS1, SMINUS3, or 424B forms in the last 90 days, which is a positive sign for the short squeeze thesis, as it reduces immediate dilution concerns. Recent reverse split watch. Another crucial piece of information for ICCM is its recent reverse stock split. The company executed a 1:4-30 reverse split on June 4, 2024, which was 42 days ago. A reverse split reduces the total number of outstanding shares and consequently increases the share price proportionally. For example, if you own 30 shares at $1 each, after 1-4-30 split, you would own 1 share at $30. Historically, many microcap stocks tend to see renewed volatility or even a price pop within about a month after a reverse split, as the reduced float and higher share price can sometimes attract new interest or shake out existing positions. While ICCM is now slightly beyond that 1-month window, the post-split dynamics are definitely worth noting given the existing hard-to-borrow situation. This pattern is a tendency seen in some microcap names, not a guarantee. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, what should we be watching for with ICCM? The current CTB of 627.5% is extreme, but it doesn't guarantee a squeeze. Short sellers are paying this fee for a reason. For a squeeze to develop, we'd need to see a few key things. First, a significant and sustained increase in buying volume. Share volume bars today's volume for ICCM is 74,370 shares, which is dramatically lower than its 30-day average volume of 6,809,802 shares. This means the relative volume is currently near Xerox average, not enough to spark anything. We'd need to see that volume pick up considerably. Second, a continued reduction in the shares available to borrow, which would further constrict the supply for shorts. And third, positive price momentum, particularly on strong volume, that forces short sellers to begin covering their positions. Remember, while a high cost to borrow is a prerequisite for a squeeze, it also implies strong conviction from the short side, who are willing to pay significant fees to remain in their bearish bets. ICCM, ICCM Medical Limited, presents a fascinating case study, with its astronomical 627.5% cost to borrow, extremely limited borrowable shares, and recent reverse stock split. This combination places it firmly on our radar as a hard-to-borrow stock with squeeze potential, if the right catalysts emerge. However, without significant volume and positive price action, the high CTB could simply signify a deeply entrenched bearish sentiment. It's a compelling situation that highlights the complex dynamics of microcap trading. What are your thoughts on ICCM? Let us know in the comments below. If you found this breakdown helpful, please like this video, subscribe to the channel for more unique stock analysis, and hit that notification bell so you don't miss our next deep dive. Thanks for watching, and we'll see you in the next video.